Good afternoon and welcome to Governance Dialogues. My name is Elisa Cole and I'm the Managing Director of Governance Center. And for those of you who are joining us once again, it's a pleasure to host you back on this program. And for those of you who are new to Governance Dialogues, it is a program that I host on a periodic basis to delve into important governance developments. And we've done so over the last few months in conversations with regulators, with board members, with investors, and market participants. And today I would like to take a slightly different approach and explore a topic that we have not yet the chance to address on this program. And that is an important topic, in particular in light of the COVID crisis and some of its consequences, a topic related to state ownership and the rising state ownership in the economy. And it's interesting for, I think, a number of reasons at this point. One is, of course, the rescue that governments are currently orchestrated and have been orchestrating over the last few months to rescue some of the national state-owned companies, but also some of the private companies. The acquisitions by sovereign wealth funds worldwide, in particular in resource-rich economies, of some companies, in particular on the back of sort of low valuations in Europe and other emerging markets, of other private companies, which also has a secondary consequence of raising state ownership. And we're also seeing a number of discussions, on the other hand, about privatization. Notably, most recently, I think the Indian announcement that from the Central Bank of India that underscored emerging interest to reopen the conversations of privatization of state-owned banks. And so we're seeing, I think, what I believe is an interesting picture and a mixed picture of, on one hand, rising state ownership, and on one hand, still some remnants of the conversation of the Washington Consensus looking at whether state-owned enterprises merit to be privatized in order to be rendered more efficient. And we're seeing, I think, this tension or this dichotomy still go on in the heads of policymakers. And with that in mind, I've invited on this program today a foremost expert on the issue of state ownership, somebody that I've had a chance to and a pleasure to collaborate over the last few years on this issue, Aldo Musacchio, who's joining us today from the United States. Aldo, welcome to the program.
Hi, Elisa. It's a pleasure to be here.
It's a pleasure to have you join us today. And of course, I'm very familiar with your work, and we've also had some webinars recently that we've organized on this topic, which I think gave us a very interesting source of conversation and future conversations on the topic. But perhaps for those who are not familiar with Aldo's work, I'll just say a few words about your expertise in state ownership and your research in this area. You're currently a professor of management and economics at the Brandeis International Business School and a faculty research associate at the National Bureau of Economic Research. You have also obviously been a professor, and I've known you, I think we met at that time when you were a professor at the Harvard Business School, and in particular on the issue of state ownership. You've written a series of papers that call for re-examining the conditions in which where SOEs might perform perhaps better than we would expect. And of course, most notably in that long list of publications of yours is the book that you've written with Sergio Lazzarini, I hope I got the name right, on Reinventing State Capitalism, where you examine the performance implications of different governance arrangements in state-owned enterprises. Again, a topic that I'm hoping to discuss with you a little bit more detail today. And I know you have a particular, let's say, interest in Latin America. So we'll come back and talk a little bit about the Petrobrass situation, which I think provides also an interesting background to our conversation today. But just sort of to open this talk, I think the first question that comes to mind comes back to the core arguments of your book around the varieties of state capitalism. And the first, I think, question that also comes in the context of COVID is whether interventions to state enterprises in recent months and over the last year have been warranted, and if you believe those interventions will continue, and what might be the impact on the global economy going forward.
Of course, thank you so much, Elisa. Again, it's a pleasure to talk to you about these issues. Obviously, I've been thinking about this for many, many years. let me just put a little bit of context maybe on why we wrote the book initially and how that connects to what is happening today. So as you probably remember, after the global financial crisis, people were scandalized with the level of state ownership. And we didn't know if this was good, this was bad, what was going to happen. There was a famous book by Ian Bremmer where he basically said, this is going to be like a major issue. Sovereign wealth funds are taking over. This is the end of capitalism. And what we wanted to do is really add nuance to that conversation. And the main idea that came out of that book is, look, there are, if I may, there are 50 shades of gray, right? In between like the extreme of like state ownership and the extreme of pure private ownership. Actually, the world mostly lives somewhere in between. And then very interestingly, after the book came out and we continued to study the topic, we actually realized that a lot of the companies that were scandalizing people became, some of them less relevant in the world economy. State ownership in companies like the car companies in the United States actually went away. And then if you look at like the list of the largest 100 companies, let's say right after the crisis versus before COVID, you would see that state-owned enterprises actually became less important in that list. And so we kind of started to realize that these things are a little bit cyclical. And so with COVID, what we realized is immediately is the state has to come back in, obviously, as a sort of like both lender of last resort and as an owner of last resort, talking about what you're saying. And so we're going to see things like the cruise industries now has sovereign wealth funds as owners, but things like airlines all over the world, you're going to see an increase in state ownership and a variety of other industries. Maybe later I can say a word about pharmaceutical companies, which in many countries there are state-owned pharmaceutical companies that, thanks to vaccines and COVID, are becoming more important. So there are these waves, and so what I guess the conclusion after, let's say, a decade of looking at this, or over a decade of looking at this, is that it's about the varieties, it's about the nuances rather than about the extremes. And that's why I like talking to you, because you actually understand the nuances around the world. And so
thank you. I appreciate that. And I think what's some of the points you're raising are really interesting, in particular on the sectoral front, where indeed it's and I've been writing about this too, this consideration of, or the notion of what is strategic, I think is also evolving. And you see governments also through investment policy and other instruments, not only governance, the hardcore governance tools that they might have, such as golden shares and others, protect companies in sectors that they consider of increasing importance. So, food and agriculture is a primary example of where sustainability is becoming a big question mark in the post-corona environment. And I'm wondering, to what extent do you think that there will be a recalibration, and you spoke about that just a minute ago, of sectors that, where governments have been traditionally, let's say, old school shareholders like airlines, this is nothing new, and where there might be a shift towards, sort of a decrease or detachment from some sectors and a shift towards state ownership in perhaps others.
Yeah. There are so many examples that we could talk about. For me, the most interesting one, which is more about, you will see an increase probably in state ownership, probably in oil and gas. Let me tell you why. And I think this is maybe interesting for the kind of people who follow you. As we all know, with regulations about climate change and environmental regulations all around the world are pushing for a completely new system of, how electric cars, the energy matrix of countries is changing completely towards renewables and solar and wind, et cetera, et cetera. This means that it's going to be very hard for the price of oil to stay high for very long. And maybe it's going to have a slight rebound in the next couple of years, but it's not going to be able to sustain those levels for a long time. And that means that a lot of the assets that are currently being exploited are probably going to start becoming unprofitable, and they're probably going to have to be abandoned at some point. And so right now I'm looking at a lot of these assets that I know better in Latin America, and it's very clear that a lot of them actually with oil prices below 50 are not profitable. And the question is, what happens there? What is the government going to take over some of those assets and try to continue exploiting them, even if they're actually losing money, just so that you don't have to fire a lot of people, and you don't have to stop certain dependencies you have to oil. And I feel like there are like many sectors in which you're going to see dynamics like that. In the ones that you mentioned, like in airlines, I feel that's more cyclical. And so whatever we see in terms of increases in state ownership are probably going to go away after a few years. And then there's the issue of privatizations, which I don't know if you want to talk about separately, but I am involved right now in a project on infrastructure at the World Bank, in which we are looking at countries that are trying to privatize electricity companies. And it turns out that the private sector doesn't want to buy those companies. Like there's no interest. And so in places like Brazil or Ukraine, you're having a lot of trouble trying to change the ownership matrix in large electricity companies, for instance, because state ownership, we're going to talk about it, I hope, in a second. It's a complicated relationship with the state when you invest in a company that provides such a strategic, crucial service, right? And that changes basically the expectations when you do your discounted cash flows of like how profitable this thing is going to be. You have to add like an extra layer of risk that the government will choose always to help voters over helping you.
It's true. And I think in policy advice, and we both work in that space, I think it's interesting how, the oftentimes the line of thought we find working with governments is let's just divest of the assets that are not profitable and keep the ones that are profitable. And exactly that logic is sometimes so difficult to implement, as in reality. In many countries, Egypt, for example, is one example of them, but many others as also have sort of tried to go that way. And of course, as you mentioned with the examples of Brazil or Ukraine, it's not it's easier said than done, let's put it that way. But just to come back to this, to your point on oil and gas and a couple of other sectors, I mean, we both know that historically SOEs have operated in sectors such as utilities, manufacturing, and other, let's say, heavily polluting sectors or sectors where ESG considerations do matter. And you mentioned labor, of course, keeping SOEs on the books, so to speak, of governments have historically also been motivated in many countries, including developed countries like France, by labor considerations and unions and other political factors. So with that in mind, I wonder if you could say a few words about this whole applicability of ESG concepts and the emergence of this ESG debate, which is sort of probably going to be the most used acronym this year, I think, over and above BRICS or anything else, to the world of SOEs. Is SOEs, in your mind, compatible, or the world of SOEs compatible with the world of ESG, and to what extent?
Yes, it's super interesting topic. I feel this is where we're I mean, at least in the sectors that I've been looking, you see a big divide. So the divide is between the countries that have SOEs that are partially privatized, that is, they're publicly traded, and the places where you have fully owned SOEs, like 100% owned by the state. Because a lot of the pressures to comply, let's say, or to report your ESG practices come from institutional investors. And so, like, I don't know if I think we showed in one of the webinars this we talked about this study. I did a study of national oil companies, so partially privatized and fully owned oil companies around the world. We tracked something like between 30 and 40 state-owned oil companies, and what we realized is that there is a lot of this dichotomy between the companies that respond to investors tend to have sustainability reports that are very thorough. They track their emissions. They tend to have, like, for instance, they're more careful about things like gender initiatives, a lot of more environmental reporting. And then you look at the boards of directors, and when they talk about independent directors, they're truly independent directors, professionals with experience, et cetera, et cetera. When we compare to countries where the oil and gas companies are fully government owned, we actually find a very different picture where, like, the environmental reporting is very, very sparse, very, very, very little. Sometimes they don't report emissions and things like that. You don't find things like gender initiatives. And I'm using gender because that also talks a lot about cultural differences around the world. the boards of directors tend to have more pro forma, if I may say that, independent directors, that is, people who look independent, but who were really handpicked by the government officials or by the ministry that regulates that company. You tend to see less women in these boards of directors. Most oil companies around the world have at least one woman on the board, but you tend to see less in companies that are fully government owned than in companies that are responding to the pressures of institutional investors.
It's interesting you zoom into the oil and gas sector, and indeed this is one that a lot of research has focused on, and notably, as you know, NGRI, the National Resource Governance Institute, has published quite a bit of research on governance of national oil companies, of NOCs, and I think even about a month ago they issued some quite interesting findings on that front. So that's certainly interesting, and also observing some of the recent transactions, and all of the discussions around the Aramco listing and how that transpired, and also when we look at what exchanges were willing to do in a way to attract that listing, with the LSE saying we'll reduce some of the listing requirements to attract state-owned companies like Aramco. And I think my personal guess is that this idea of listed versus non-listed SOEs, or this these two worlds, will become perhaps even more subject to further investigation, as exchanges in particular, the American and the British, the London Stock Exchange, which are both increasingly under pressure and competitive pressure to attract companies, might be, let's say, inclined to lower some standards in that field. But I would like to ask you, perhaps your thoughts on one particular situation, and that is the Petrobrass situation, which we all know is unfolding once again in the financial press, with the removal of the CEO and the subsequent loss of, I think the immediate loss was in the order of $13 billion, if I'm not mistaken, of the Petrobrass market cap. And I know this is a region you're extremely familiar with, and I wonder what your thoughts as to what are the consequences of, let's say, political intervention in the governance of SOEs, in Petrobrass, and perhaps beyond in peer-listed companies in that sector.
Yes, let me start in that case. So what happened in Petrobrass is that the CEO realized that some of the prices of the products they sell, in particular diesel, which is used by trucks in Brazil, and Brazil, it's basically a country that relies on trucks to transport everything. Like, the railways are basically taken by the mining industry. So the price of diesel is probably one of the most politically sensitive prices in Brazil. And so the CEO of Petrobras realized that the price of diesel hadn't been increasing a long time, and they were basically losing money for this. So he proposed to increase the price of diesel. And within days, the president of the country basically insinuated that was a terrible offense, a capital offense, and that the CEO was not going to be renewed in his term in the next board meeting. And that's exactly what happened. The funny thing is that investors reacted, this loss of market capitalization you described, is that the funny thing is that investors reacted as if this was something unexpected. Like, oh my God, there's government intervention in a state-owned enterprise, this is terrible. And then they sold their shares, which I always find funny, because we all know that that's the difference between a private enterprise and a state-owned enterprise, that the government is going to have some shares, and they have multiple objectives, and at some point you're going to clash with those objectives. In an article that we published in a law journal called "In Strange Company," that's the name of the article, which I love, we describe how problematic this relationship is between the state as a shareholder and private shareholders, and how basically the law and sort of the regulatory agencies and even the courts have not evolved as fast as, let's say, the corporate forms of these state-owned enterprises. That is, now we share ownership with the state in some of these companies, but we don't have really the regulatory bodies, courts, legal system that would allow us to basically sue the government as a shareholder. And this is what happened in Brazil. The minority shareholders of Petrobras are trying to go after the government, right, for taking an action that destroyed value in the company. But there is really the courts, are not ready to handle these cases. There is very little precedent. The regulatory agencies also don't have the teeth, the enforcement capability to go after the government in any way. And so this is basically where you test the limits of these hybrid forms of capitalism, right? And this happens everywhere, as you know, like in Dubai, we had that famous debt default in 2009 by some companies that were state-owned, but then in the bankruptcy, they pretended to be more like private firms. And basically, the creditors lost money with a huge haircut because they couldn't understand really what was happening. They assumed the government would bail out these firms, and then the government said, like, I'm not going to bail them out. In fact, we're going to pass a new bankruptcy law, and then you guys are going to lose money. And I feel that it's funny when you see investors complaining and reacting about these things, when in fact, anyone who has spent time looking at this, we know this is bound to happen. And when you buy these shares, and these companies should have valuations that incorporate that risk, like they should be like a discount in the valuation of these firms that incorporates this risk. The problem, at least in this, you must hear more about this, is that a lot of institutional investors have to invest in some of these countries. And because some of these SOEs are the largest companies and they have to track sort of like the index of the country, they end up having to invest in these companies at whatever valuation like everyone is coming up with, which is usually inflated relative to the risk of owning a state-owned enterprise. And in a way, it's there's nothing these companies, these investors can do because they're just bound to take these actions in order to invest in this country. So it's sad as an academic to see this, because the reality is more complex than what people assume. Sorry.
And this is why I wanted to have this discussion with you today, is because I think some of the research you're doing has direct pertinence to investors, to board members, to financial market participants on real life decisions concerning, investments in certain companies, portfolio allocation strategies and whatnot. And I think that there are a number of interesting points that you've highlighted. I mean, first of all, I think I've always wondered in my head, even at the time when I was at the OECD, to what extent international guidelines like the OECD Principles for Corporate Governance are applicable in reality to different country contexts where ministerial representation or ministers chairing boards is actually common, and is the case, as we both know, in most emerging markets. I mean, so when I think about the OECD principles, they sort of neatly apply to the case of Norway, to the case of Sweden, maybe to an extent to the case of Central European countries, but I think much less so. And so I think that's an interesting area of thought as to what can be really done in practice to prevent, and I've had many conversations on this, to prevent, let's say, political interference when the minister is at the one hand a regulator and also chairman of a company, and what kind of safeguards can you in reality introduce, because that's the reality of most countries. It is not this kind of, as you say, black and white. It's really the 50 shades of gray kind of situation. So that's the first comment. And I think the second point that you're making that's very interesting is around this kind of commingled or co-ownership between private and public. In my work, for example, I see that's a tendency that I think will grow increasingly in countries like Saudi Arabia, but many others like Korea in the past, where that kind of configuration had worked out, I would say, relatively with good results. So that's also a very interesting point that you're raising. And the third point, on which I'd like to follow up perhaps with a question, is around risks. You mentioned risks to investors when they put money into SOEs. And of course, we know that, as you say, institutional investors need to allocate to China. And, the most of the market has government participations. And I wonder if you could say a few words, if you think that institutional investors are aware of these risks today, and do they have sort of, should they be introducing other tools or sort of having other tools in their pocket when they actually have portfolios invested in companies that have state ownership? Are there other lens that they need to kind of put on in order to understand the risks that are salient in SOEs versus other listed companies?
Yes, of course. I feel one of the problems, especially with certain institutional investors, is that they have to do certain things kind of mechanically. Like, for instance, if a lot of portfolio managers or fund managers, they have to beat like a certain benchmark, and that's how they get compensated, right? And those benchmarks, for instance, if you invest in emerging markets, which is kind of the part of the world where you and I spend a lot of time, like the indices that track the performance of emerging market stock prices are usually weighted by market capitalization, right? And I mean, they have weights by country, but then within countries, you have weights by market capitalization. And guess what? The largest companies in a lot of these emerging markets are state-owned enterprises. And so just mechanically, because of how the compensation and the incentives of these fund managers is designed, they actually have to try to track and beat these indices that are heavily tilted towards state ownership in many of these countries. And so I feel like in that way, they're trapped, and state-owned enterprises, the people who run state-owned enterprises, when they're smart, they know it, they take advantage of that to do placements of equity issues. In the case of Brazil, they have preferred equity, for instance, so they can sell equity without voting rights. So it's great. And then the other part that is kind of interesting, it's not so much about institutional investors necessarily that invest in equity, but in bonds, is that these state-owned enterprises issue bonds. And you would think that investors would not like to buy the bonds of companies that we know may be more inefficient, especially the fully owned state-owned enterprises. And when you look at the research, it is actually really funny. When they are partially privatized, investors they issue bonds. Investors in those bonds actually they actually have a discount for those bonds. When the companies are fully investors actually require that these companies, when they're partially privatized, they require that those companies pay a premium because of the risk of state ownership, or at least this is what the research says. But then when you go to like fully state-owned companies that issue bonds, right, like many of the companies that you study in the Gulf countries, in Africa, in Latin America, what we actually find is that there is a discount. Why? Because investors implicitly assume that governments are going to bail out these firms. And so when they make their evaluation or their valuation of risk implicit in these bonds, they actually consider the balance sheet of the entire government and not the balance sheet of these companies. So there are a lot of like these very interesting quirks, if I may use that word, these very interesting, like weird things that happen in the world with state ownership, in which investors are kind of like helping, let's say, to continue to promote state ownership just because of how the rules and how things are operated in those markets.
It's interesting, and actually, this very point that you're alluding to, I've had in a previous interview that I did on this program, I had a head of index strategies of S&P, Craig Lazara, and we discussed some of these implications. And from what you're saying, it sounds like to me, and I'm thinking of a book that I very much like, Catch-22. I'm sure you've read it too, in a sense that we are in a situation where there is kind of an assumption that listed or public markets are generally private, but in reality, we're looking at a world where, in fact, it is nothing of the sort. And so, and in a way, from what you're describing, again, we're in kind of in a situation where institutional investors are potentially, for the lack of a better word, perhaps perpetrating. Is that? Do I understand you correctly? That photo?
Yes, they're in a way facilitating, let's say, the state ownership in these countries, like because of how they invest and because of the rules they created, they're actually helping governments to continue having these forms of ownership rather than, let's say, incentivizing privatization, which is what maybe the more pro-market people would want. We're, on the contrary, we're not promoting privatization in that sense. We're actually promoting state ownership with these rules.
It's interesting because I think it's exactly perhaps the opposite photo that most investors or financial market participants have in their mind. And so as we kind of draw to the conclusion of this conversation, I just want to put out perhaps a more controversial question around what investors could expect in this world of state-owned enterprises, where, okay, we know that the Trump administration has, for example, taken some measures to delist these three telecom companies that were allegedly tied to military interests in China, and they're taking further action through a different source of legislation to allow PCAOB access to to audit trails of Chinese listed issuers in the US. So there might be, and I wrote about this in a recent piece, kind of a tension in the capital market space, which is indirectly around this issue of state ownership and dual listings and state-owned enterprises. But just to ask you, perhaps the last question is around what we might expect to see in the world of capital markets and state-owned companies. Do you believe that given, let's say, lessons of history, which are, I think, always indicative of the future, at least to some extent, will we be seeing more of Petrobrass-like situations? Will we be seeing more of concerns raised with, let's say, oil and gas SOEs that tap into public markets, especially if they go to, let's say, the LSE or NICE or other developed markets? Or is that more or less, let's say, an issue on the margin?
Yeah. So on the issue, I mean, there are two issues here. One is like, can we expect more state ownership? The answer is yes. I mean, we're already seeing it in like many of the mini bailouts that we have started to see in Europe, in other parts of the world. Sovereign wealth funds are having a blast. They're having a party right now because of, all the industries that got shocked by COVID had excellent valuations. And so we are, we just downloaded some of the ownership data for SOEs to track this. So I don't have a concrete answer, but I know, from what I read in the newspaper, that they're definitely taking good positions in a lot of these firms. So you will see definitely more state ownership from that perspective. And then all these mini bailouts, what my sense is that it's probably going to fade out after like 3 or 4 years. You will see, like, the German state probably will sell some of its shares in Lufthansa once things normalize. The thing is that there are other sort of like more sort of like overwhelming things happening in the world. And the main one that I see is how, climate change and environmental regulation is going to affect a lot of the industries in which states are dominant players, and how they're going to try to desperately sell shares. But I don't know if this is going to continue. So like this thing we're seeing with Aramco, that they decided to privatize some of the shares and that they decided to pay the dividend, even though they shouldn't have paid the dividend. For me, it's showing signs that there's going to be a little bit of a desperation of governments to try to sell some of the assets that they know are going to be stranded. Think about in the energy sector, in electricity, plants that use coal, for instance. Those are definitely going to be stranded assets for governments. Those are going to be like losses for governments down the road. So they're going to try to privatize them as soon as they can to sort of share the risk. In oil and gas, we're going to see big changes. For instance, changes in taxation, how oil fields are taxed, how much government shares risk with the private sector and things like that, because the private sector is going to start losing appetite to exploit very difficult fields and very complicated fields, etc. So
interesting.
We'll see a big change in ownership, but more because of things like climate change and environmental regulation than because of I think some of the COVID effect will fade out. Obviously, the sovereign wealth funds will stay and will invest and will be there, but I sort of feel like governments are going to start to feel the pain of having kept some of these inefficient electricity or oil and gas companies down the road.
It's interesting because a lot of the insights that you shared today sort of in many ways go against conventional wisdom or sort of what the talk in the financial press. So I think it really gave an interesting flavor to this conversation around SOEs, both in the world of public equity markets, but also as a food for thought, perhaps for policymakers. And perhaps, going forward, there will be also new ideas that will be considered. We always had in the world of equity markets, different listing tiers based on corporate governance, based on trying to attract SMEs. And I wonder if, I think it's not for tomorrow, but if there will ever be kind of a thought about listing segments or specific rules for state-owned enterprises. But that's perhaps a bigger controversial question that we won't have time to explore in this conversation. But I would like to, first of all, very much thank you for joining and for sharing your thoughts and very interesting conclusions of your research. And it sounds to me that perhaps in 1 year's time, we should follow this up with another temperature check on this issue, no?
Of course, yes. There's going to be a lot that is going to happen in this year. So it's going to be super interesting. Thank you so much. It's always a pleasure.
Thank you so much, Aldo. And for our audience, please feel free to reach out to us with your thoughts and suggestions on the topics that we are exploring in this program, and also to subscribe in the link that's directly available in this video and in all the other episodes of the program. Thank you for joining us today.